Shall we move to the disclaimer? Yeah, this is a disclaimer from company's point of view. So you may go through the green highlighted portion. Yeah, next slide. Yeah, this is today's agenda. First, I will give brief introduction about the company. Later on, Ms. Shreya will give the investors presentation for Q1. And in the last, Mr. V.S. Reddy will take the question and answer session. These are the guidelines for today's meeting. All the participants are kept on listen-only mode by the host. All the participants are requested not to record the call. Questions from the participants will be addressed in the Q&A session at the end of the investor presentation by the management. During the question and answer, when called out by the moderator, we request you to introduce yourself with your name, organization, and the question. Participants having multiple questions can email us on email ID mentioned in the chat box, and management will make best possible efforts to revert within 7 days. Thank you for your cooperation. So I'll give the brief introduction about the company. Dear participants, welcome to the Q1 of financial year 2025-26 earning call and investor presentation of Synergy Green Industries Limited. Synergy Green Industries Limited is one of India's leading state-of-art foundries producing HDI, grey iron, and steel casting for wind turbines, wind gearbox, and general engineering industries in weight range of 3 to 30 metric tons. Synergy Green has an installed capacity of 30,000 metric ton per annum and is in process of upgrading to 45,000 metric tons. The company houses best-in-class equipment, IT infrastructure, and quality testing facilities, and is a top supplier to major wind OEMs as well as leading gearbox players in the world. SJIL is a part of the Shirgaonkar Group, which has diversified businesses interests over its 80 plus years history spanning across sugar manufacturing, foundries, hospitality, and market research, among others. We have with us today Mr. V.S. Reddy, Executive Director of a company. Mr. Reddy is a BTech in Mechanical Engineer, MTech in Manufacturing, Executive MBA from IIM Bangalore. He has over 30 years of experience in manufacturing of large castings. Over his career, he has worked for corporates like L&T, ISGEC, and Simplex in establishing plants and managing businesses before joining Synergy from inception. Second, Ms. Shreya Shirgaonkar, Management Executive. Ms. Shirgaonkar has completed her MBA in Finance and has worked with Deloitte as a part of their energy and industrial research team for over 4.5 years before joining Synergy in 2023. And myself, Nilesh Mankar, I am a company secretary and I have also completed my MBA from Indira Gandhi National University, Open University. I have more than 13 years of experience in the secretarial department of a company. Now I would request Ms. Shreya to give the presentation of first quarter of financial year 2025-26. Over to you, Shreya.
Thank you, Nilesh. Today's presentation will be divided into three major areas, which is the industry overview, company profile, and business performance. However, for today specifically, I'll be majorly going quickly over the industry overview and company profile and majorly focusing on the business performance for the first quarter. I'll gloss over the industry outlook and we can maybe address this in the Q&A session. Just a quick glance again at the company. Synergy is one of India's leading manufacturers of flat-size critical castings, majorly for the wind and general engineering products. The weight range of our castings is 3 to 30 metric tons single piece. The materials that we produce are SGI and cast iron and a small portion of steel. Our capacity currently stands at 30,000 tons per annum, and we're in the process of upgrading ourselves to 45,000 tons per annum. We have state-of-the-art facilities as well as quality certifications and an NABL certified quality testing lab. Our products majorly go into the wind segment. 70% of our products go for wind castings, 15% towards wind gearbox castings, and the balance 15% for general engineering applications such as in industries and such as mining, plastic injection machines, as well as pumps. We're trusted by 50% of the world's top 10 wind OEMs as of 2024. These include Vestas, Siemens Gamesa, GE Vernova. Besides these, we're in the process of onboarding Envision and Nordex. Within the gearbox segment, we cater to the world's gearbox leaders, Flender and ZF, as well as the tier 1 companies from the non-wind segment such as Terex, Millicron, and Willow. I'm jumping directly into the business performance for the quarter. Our annual capacity utilization was at peak levels in the last year. For FY24-25, we were at 88% of our capacity utilization of the 30,000 tons per annum capacity. Now here is the summary of our audited financial results for the first quarter of FY26. The total income for the quarter as compared to the first quarter of FY25 has risen by 8% and stands at 85.38 crores. The PBDIT has risen by 25% over the corresponding period in the previous year, and it stands at 13.16 crore. And the PBDIT margin has risen by 210 basis points and stands at 15.41%. The profit before tax stands at 5.13 crores. This is a 26% increase over the corresponding period of the previous year. And the profit after tax has risen by 14.44% and stands at 3.38 crores. Here's a quick glance at the balance sheet. The key items in the balance sheet, such as inventories, trade receivables, as well as trade payables, are in line with our expectations. The other current assets have increased majorly because of the capex that we're doing currently, as well as the GST credit receivable. Here's a snapshot on the progress of our order book as well as product development with various key customers. So we've received schedules of about 167 crores from Vestas, which are to be executed in the calendar year of 2026. We've also received a development order for Vestas's 4 megawatt platform, which will also begin shortly. Siemens Gamesa, which is SGRE, is already in the pipeline to restart production, and we're expecting this to begin in the third quarter of this financial year. We're proud to announce that we have successfully produced India's largest wind turbine casting made in India of 29.5 metric tons for Nordex. You can see a snippet of this casting on the right-hand side. For Envision's 3.3 megawatt platform, our prototype castings are complete, and so we'll be ready for serial production. As for Adani's 3.3 megawatt platform, the products are under development currently. This was a quick view of some of the key developments as well as order book for our key wind customers. Now I'll walk over the brief overview of financials. So as mentioned earlier, our revenue for the first quarter of FY26 has risen by 8% over the first quarter of FY25. The key drivers or growth drivers for this revenue are the gearbox segment as well as our direct exports that have gone up. Another trend that we've highlighted even in the past, and we see it again this time, is the wind domestic segment, which usually is slower on the offtake in the first couple of quarters of the year. We still expect to see around 20% of the revenue growth in FY26 over FY25. Drawing your attention to the PBDIT of the period, PBDIT has increased by 25% and stands at 13.16 crore in this quarter. PBDIT margins stand at 15.41%. We're expecting an overall increase of about 100 basis points for FY26 over FY25. Here's a look at the CapEx plan and status of each activity. So we're doing a major expansion and CapEx cycle currently. That is around 187 crores. This is mainly divided into three major areas. The first one is the foundry expansion, where we're expanding our capacity from 30,000 to 45,000 metric tons. We've allocated around 60 crores to this area, and the equipment erection is in progress. We've also shown the picture of the new factory shed at the bottom. We're expecting it to be operational by Q3 FY26. Our captive renewable power, which is increasing our solar capacity, which is a captive solar, from 2 megawatts to 10 megawatts. We're installing 8 megawatts this year, is under commissioning. It's at the last stage of its commissioning and is expected to be operational this month. The final area that we're investing in is in-house machining, which was so far outsourced entirely. We're doing this CapEx in two phases, and the target is to establish a total of 20,000 tons approximately per annum of machining activities in-house. So the first phase of this activity is already underway, and the machines are under erection as depicted below. These are expected to be operational by the third quarter of this year. And finally, the last leg of the CapEx will be with the extended capacity for machining, which will be operational by the fourth quarter of FY26. Looking at the path ahead, our performance outlook, we're expecting 20% growth, which is expected for the whole year. We have some robust projections for the order book from major OEMs in the country, as well as our gearbox customers. The export revenues are projected to remain stable, close or similar to the previous year's export revenues. And finally, as mentioned earlier, PBDIT margins are expected to expand by over 100 basis points from the previous year. This was a quick overview of all of our financials as well as the status of our investments. I would like to open up to the Q&A, and if anybody would like to, Nilesh, do we have any questions already, or should we open it up to the audience?
We can open it up to the audience because we have not received any question.
Sure. So I'll hand it over to Reddy sir for the Q&A. I already see we have two questions, I think.
Good evening, all of you once again. We welcome to this investor conversation. I see Mr. Anadura Sethi is going in. Please go ahead with your question, please.
No, thank you for the opportunity, sir, and that was a very good opening presentation. Mick, just two questions to start off with is, we are on a strong expansion plan. We want to go from 30 to 45, and I see that this quarter we're looking to go from 45 to 75, which I think is a bit higher than what we were talking about in the past. So maybe if you could just share some color around what's changed, what makes us more optimistic about the medium term, and also if you could call out typically our order book, how much visibility of this growth is basis the order book that we have today, and how much will be more orders that we expect over time?
Till last year, our major business was surrounded between two OEMs, that is majorly Vestas and Siemens Gamesa. And during this last 12 months, we have added three major OEMs, that is Nordex, Amazon, and Adani. Typically, each OEM comes with somewhere around 10 to 15,000 tons kind of demand, actually, which we are similar numbers we are utilizing to Vestas, actually. So if we presently if you look at the kind of capacity what we have, we are just increasing from 30 to 45,000 tons. But the way I look at the customer demand forecast and all, with the agreed share of business anywhere between 25 to 50%, depending on his supply chain model, I already see my demand is going beyond 60,000 tons, actually. No, apart from this, we are also seeing a good growth in the gearbox segment. I do see a lot of opportunities in the non-wind segment as well. So this capacity, what we are adding up, it will be quickly utilized. That's what we are projecting. In fact, order book is already fully is there. So considering this, we feel there is a strong requirement for further expansion beyond 45,000 tons.
Got it. So, at this point in time, how much of our exports would be to the US? And, just with this tariff uncertainty, how are customer discussions evolving at this point in time?
See, last year our export was somewhere around 18-20%. I remember the number. But current year, since it was flat but the business is growing, we are expecting the export proportion to be around 15%. Out of which 50% of the dispatches we have done in the first quarter itself, because we had a skewed schedules. Now, coming back to what is the impact and all, it is slightly difficult to tell what is happening on the other side. The only one thing I can say, the parts exports which we are doing, the majority of the parts are single source actually. It is not easily possible for them to switch overnight. That's one, unless there is a change in demand actually. Means if the demand in US market drop, there may be impact in the export. But in total, I don't see, just because of the tariff, our schedules are going to significantly panic and it will go up. We are not anticipating that kind of thing. Just I will give a quick example. About a year or 2 years back, because of the Red Sea problem and all, there was a significant increase in the logistic cost. Means customer has borne almost 25-30% extra logistic cost to pull the castings actually. So and the second thing is the total the cost structure in the wind turbine, ours is around 3.5-4%. So if there is a 25% impact is there, maybe 0.5% or 1% will impact. So just because of the casting, something getting stopped, I don't see that kind of challenge. The bigger issue is if the one who is assembling the turbines in US significantly depend on the imports, then overall cost structure get disturbed. And if they are not able to pass on, there may be some impact on the demand. But the way I look at today, there is a minimal impact on the projections which we are given, which has quoted, because today I'm sitting with a lot of domestic demand as well, that will easily get replaced actually.
Got it. Got it. And so just one final question before I join back in the queue is, there are three projects, 2-3 projects that we're doing, which can actually help us improve our margins. We've spoken about 18% margin in the past. So my question here is that, we are looking to do machining probably in-house for the first time. So what is the learning curve that we kind of should expect over here? And do you think getting talent, for machining could be a problem? And 18% EBITDA margin at say 45,000 metric ton, do you think that's a high probability outcome for you guys?
First part is as per learning curve, you are right. It's a technological thing. It's a new thing for us. But we do have a team where we're having some around 25-30 years of experience, people already with us for last 6-7 years. Because this machine shop we wanted to do somewhere prior to COVID. But 2 years there was a challenge because of the Russia-Ukraine commodity cycle and Russia. This got postponed actually, the machining investment. Now, during this period, last 5-6 years, our team has spent a lot of time in developing my local supply chain. So we have seen demonstrated our capabilities in establishing the machine shop. I don't see a big challenge in establishing the machine shop. Maybe initial 15 days, 1 month, there can be, that is a part and parcel of the manufacturing activity actually. So that is one. And your second question was on to...
So given, with machining, with solar...
Yeah, you are talking about the margins,
Yes.
achieving the margins of 18%. See, typically the machining alone contributes around 12-14% of our cost actually, but still we want to do only 50% of it. So I expect somewhere around 5-6% kind of the contribution will happen. And also solar, we are spending almost 8% of our balance sheet into the electricity. But the investment what we are doing today, 2 megawatt, which is earlier we are having, and 8 megawatt right now commissioning is happening, total takes us to 10 megawatt. That will take around 40% closer to the kind of the capacity with the electricity, this thing, so that adds another 3-4%. I don't see big challenge in 18%. It should be better than 18%, but we have cushioned something. If you have to grow business, something need to be passed on to the customer. I also see a lot of other avenues actually. Work is, my first part is, this is a brownfield project. So my manpower cost is not going to just go up by 50% with a 50% increase in health. Means there must be some kind of a volume leverage should be happening actually. Then I'm not even spelling out something on the market, increase in volumes. And there are a lot of other opportunities opportunities are there to improvise the balance sheet actually. Considering this, I feel it should not be a big issue in achieving the 18% plus kind of the EBITDA margins.
Perfect, sir. Thank you so much. I'll join back.
You're most welcome. May I request Jiten Parmarji, please go ahead with your question, please.
Good afternoon, Reddy ji.
Good afternoon, sir. Good afternoon.
Yeah. So some part of my question is already answered in the first segment. But coming to specific on it, out of the 15% exports we are going to do this year, how much of it is to the US?
No, the majorly is US only. See,
Majorly.
Europe is less actually, maybe 2-3% only. Major is US export actually.
So is there, let's say, I mean, maybe I think I have seen and spoken to companies and all that, like this 25%, a lot of people have kind of worked around and said, okay, I will bear this, I will pass on this, I will, but if it goes to 50% or beyond, the way things are, how difficult it becomes for us at, like this 50%, if it sticks, does it dent us, and do we have alternate markets for this?
No, we'll not be chasing US market for sure, actually, the first thing. Second thing is, like Vestas is operating in India and in US. The major business is coming from Vestas only, the exports, whatever we're doing it
Right.
actually. What I understand from the Vestas is they're going to divert their assemblies from US to India. So it's not only for me, for them also they have to figure out. Even
Okay.
tomorrow, for me, US market becomes zero. Still, I don't see any problem going ahead with the plan what we have mentioned. That is, apart from 45,000 tons, going up to 100,000. That's the kind of demand. I see a lot of opportunities actually. See, wind is only one segment. Probably some of the investor discussions when we discuss the total addressable market for us is there is a 6 times market is sitting on the other side apart from wind actually. So something like pumps, mining, machine tool, mining, a lot of opportunity actually. So just for a small business of 50 crores, 100 crores, something happens in US, I don't see our growth will get impacted because of this actually.
So yeah, so that is heartening to hear that we are looking at other things also, because I kind of always thought that it is always better to have other streams. So, and you did talk about good demand from the gearbox, from the gearbox segment and non-wind segment. The way things are, and if we were to expand further, maybe 4 years, 5 years down the line, how much percentage do you think will our aspiration will be to be from the non-wind segment?
See, I don't see any problem in going to 50-50. See, that is one of the reason why we have, from the day one, we maintain 20-25% of the composition from the non-wind segment, actually. Second thing is, I'm not too much concerned about the demand going down. That is unlikely to happen. The reason I will tell you, actually, wind is in the early phase. It has not shown its potential performance, if honestly I have to share, actually. For example, last 3 years or 4 years, it is barely doing 3-4 gigawatt kind of. That is not the number what India wants. In fact, I feel this Russia, whatever is, US, whatever is criticizing on Russia oil import and all, it only pushes more onto the renewables actually. At the end of the day, what is that we're discussing? Oil import, right, from Russia. It's a energy security. So energy security is coming from the renewable sitting at your home without anybody, either US intervention or Russia intervention. That's the best thing can happen to the country actually. Apart from preventing the foreign exchange outflow actually. So India should put more effort today to reduce the dependency of the energy from outside. That is what the government is going to do. I am a very strong believer of that. That is one. Second thing, the last 2, 3, 4 years, if you carefully seen, solar has done more than wind actually. Like 20 gigawatt kind of numbers happening in solar, but only 3 or 4 gigawatt happening in a wind. But I was wondering how this mismatch can happen. The reason is solar was an easy thing to do it because it was in the early phase, less complexity in, unlike in wind and all, ticket size is less, and so many other things are there actually. But the biggest thing we haven't in the month back, that is on the Maharashtra State Electricity Board actually. Nowadays what is happening, a lot of solar project has happened, more power is getting injected in the daytime, nobody is there to supply in the evening or night time actually. That is where wind is going to do it actually. So now Maharashtra government has come with a policy wherein they are discounting 20-25% of the solar energy and they are incentivizing 20-25% of the wind. means there is a 50% more incentive to go towards the wind. So I believe the going forward, there will be more of wind installation than the solar. That is how the typically, if I go by economics, that should be the future upcoming trend actually. Second thing is, now whatever happens in Maharashtra, definitely that is going to repeat in whether it is Rajasthan, Karnataka or Tamil Nadu, that is going to fall like, everybody has got the same problem. Means solar, it generates electricity only in the daytime. So considering that, I see one is from the US Russia story, whatever is happening, pushing towards the higher energy, and that higher installation should be skewed more towards the wind. This is how I look at actually. At the end of the day, the capacity whatever is a too small capacity. I don't see any problem up to 1 lakh ton kind of journey actually. We are looking beyond 1 lakh ton. Means maybe how do you secure up to 200,000 tons kind of thing? Wherein can we look at 100,000 tons from non-wind? For sure, we'll be doing 100,000 for wind actually. That much confidence I have.
Perfect, perfect. Great to see that. And my last question would be on the electricity. We with the commissioning of this plant, 40% of our, we can say that we are captive, right? That is on the 30,000, right? Is that right?
It takes care of around 15,000 tons of production actually. So you can
Okay.
calculate whatever the number
Okay.
actually.
Okay.
So
So
10
yeah, at
megawatt takes
45
care
it
of
will be
15,000
1/3.
tons.
Okay.
Yeah. Yes.
So are there any plans to further ramp this up? Because we still have room, and do we have space and all this for this thing? Is there any thought that and what is the cost saving on let's say this 1/3 portion of
Yeah.
captive and
You
the
are,
payback period?
yeah, you are rightly mentioned. In fact, now what we are thinking is go more towards the wind, because we need to balance between because consumption factory is running 24/7. Now today, since initial investment we did on a solar, but next investment we will do wind, because it will be covering the evening and night portion of the consumption actually. We are thinking to add another 4 megawatt of wind, which is equal to 8 megawatt of solar, because the wind PLF factor is more than 250% like solar. Like solar may work with 17% of the PLF, as against the wind maybe 38% actually. So it generates more electricity for the same megawatt of installation. So again, there are certain guidelines. We cannot go 100% unless you generate energy for around the clock, which is a very challenging thing. Probably 60-70% energy definitely we can go. So again, we don't want to go leverage the balance sheet and go into too much of debt. So because we have also taken a lot of capex on the foundry machining and all, 10 megawatt is a sizable thing, but we should be able to either this year or next year. May not be this year, but next year definitely we would like to add another 15,000 tons offset through the renewables actually.
Okay, perfect, perfect.
Yeah.
And
Thank you.
final question, if I may, regarding this efficiency or improvements with the higher wattage turbines and all that, with like 3.3 and 4 and 5, is that improving? I mean, if you can throw some light on that.
No, there are two parts into that. If you are typically looking at the casting consumption per megawatt, that will go down, because that is the optimization process. The tonnage consumed for a 2 megawatt turbine, when it goes up to 4 or 5, definitely it will come down by 15-20% actually. But that is not our concern, the consumption. We are looking at more volumes getting executed actually. And
Right.
as far as the industry is concerned, yes, the bigger turbines are more optimal, gives a better efficiency, and the more investment happens. That is how the cycle works actually.
That's what I was
Yeah.
hinting at.
Thank you.
Thanks. Thanks.
Yeah,
I
thank
think you
May I
answered all
request?
my
Yeah.
questions.
Thank you. May I request Mr. Prateek Jain to go ahead with your question, please?
Hey, hi, sir. Thanks for the opportunity. So my first question is, if I just look at the global lay of land, right? There was China who is dominating the market in wind castings. Then there is India, and then there is Europe, right? Like you mentioned, that majority of our supplies are going to US as of now, the export supplies. So wanted to understand that how is Europe plus one playing out here? Are European foundries losing their market share, and who is catering to that demand as of now?
See, there are two things in that. One is today Europe is still having a reasonable capacity to take care of the European market. And if I look at the cost structure between India and China, China is more competitive than India. Like many times I mentioned, it's around 25-30% cheaper than the Indian market. Now, till yesterday, there was a 25% tariff barrier difference between India and China in the US market. There is no such tariff barrier in Europe. So today, if at all any European OEM has to buy, they typically used to buy from China actually, no. But I see a lot of European OEMs. In fact, there is a discussion going on to export to Europe. Actually, I really don't know what is it can be a strategy because of China plus one. Like, because if he's buying 100 from China, it doesn't impact his cost structure to pull out 10% to India actually, no, because 10% is also big number to coming to the Indian perspective. But as on date, we are not gone to the European market significantly. There is a small business happening, is mainly because of we ourselves were sitting with the capacity constraints actually, no, because not able to take care of the either US market or the domestic market. I do see opportunities to export into the. We are in discussion with one of the OEM. He's talking about exporting to the Europe. We'll see how it gets unfolded actually, no? But prior to that, I feel the domestic market, like if the 4 gigawatt happens to say 8 or 10 gigawatt, the demand also is going to get doubled in India itself actually, no.
Got it. Got it. Yeah. And so, apologies firstly to, being repetitive on the earlier question. So I understand that you have you have mentioned it multiple times that at some point in time you will like to have a mix of, wind 50% and non-wind 50%, right? Um, the world is uncertain, right? And we have seen that wind has been more lumpy than the non-wind segment because just the nature of the industry as of now. So, as an entrepreneur, how do you think about taking a conscious call of, de-risking from wind segment and just filling the capacity from the non-wind segment today?
See, I will tell you one thing. We are in this industry for 15 years in Synergy. Personally, I am in 30 years actually. No, during last 15 years, our revenue growth did not happen for only 1 year. Means out of 15 years, 14 years we have grown. So from outside, it looks very bumpy or volatile actually, but I don't see that kind of the threat or the problem. The reason is we always built a capacity when enough demand is built in the market. Like now, if we are moving from 30 to 45,000 tons, it is not that we are building capacity then and we are going for a searching of the market actually. No, today if I look at my demand is built up beyond 45,000. It is I clearly see if I push it, I can easily sell 60,000 tons kind of customer. So I don't see any problem in whatever is going on. The second thing is, the casting business is so wide, it doesn't take much time for us to pull out some other business section, the kind of the credentials what Synergy has today. If I go and stand, I don't see any challenge in getting the businesses from any other segment actually. So overall, I never look at the demand side as a concern point for us actually. But only thing we have to manage the economic cycle, capacities, operations, execution. This is where our focus point is actually. Now the regard the diversification of the non-wind, I do know because the way Chinese, one of the reason for their competence is because they're highly concentrated on one industry. Wind means wind actually, but you get a lot of efficiency when you focus a lot. But today, because we always feel would like to have a diversified, so we are managing a lot of non-wind customers actually, So we sacrifice some efficiency, but we have a good diversification in the organization. So I don't see there is any threat on the demand side because of all this volatility and other things. One last point I would like to add actually, if you look at around 10 OEMs are there in the country today making wind, but how many foundries are there producing the casting? So whether X OEM gets, Y OEM gets, ultimately order is going to split between 1 or 2 producers in the country. That is another advantage where we are sitting at. So there may be volatility in the OEM side, but not too much volatility on the supply chain side actually. This is how it works.
Got it. Got it. And just a last question. Can you please highlight the amount of capex you will be doing in FY 26, 27 and 26 and 27?
So there are 2 parts which I mentioned. As far as the current capex of closer to 187 or 200 crores what we're doing it. This takes care of the capacity of 45,000 tons and 20,000 machining and 10 megawatt of this thing, solar. I do see in the existing infrastructure, whatever we're doing, another 20 crores, 25 crores kind of the investment in the solar or renewables, whether wind or whatever is there. That can be one thing. It's a purely as part of the cost optimization part of it. I also missed to answer the previous Parmaj's question. What is the payback period? Payback period on the renewables is less than 4 years. For sure, 3.5 years is what we're doing. So that is worth investing it. There is no doubt about it actually. The second thing is I also see some kind of opportunities in the machining capacity because we are not invested into 100%. Whatever the capex we are taking, it is taking care of only 20,000 tons. But we may still think of putting another 10,000. So that takes care of the existing capacity what we have. But if you have to answer the second part of the question, 26 and 27, we are looking at the second phase of project, that is on the increasing from 45,000 to 100,000 tons or 120,000 tons. That progressively, if I take up like similar way, foundry, machining, and renewables are put together, it may go around 400 to 500 crores. But again, we may not be doing everything overnight. We'll be doing progressively. Maybe initially, first shot, we may go with the 300, 400 kind of capex. Later, we'll top up with another 100, 150 crores. That is how we'll take step by step. See, at the end of the day, we have one fundamental principle. First is we have to get 20% plus growth. Second is we have committed to achieve 18% plus kind of margin. Then doing investment in this kind of business model is not the challenge actually. No. Then third fundamental rule what we're following is we'd like to maintain our debt to equity ratio under control. So in no case it should be exceeding 1.5. For sure, we'd like to contain below 1. So then the business is in a manageable situation. We are not in a hurry to rush because there is a demand, go and do big leverage and go into debt and all. We don't want to get into that kind of hurry. Actually, there is a time. We have enough of this thing. We have planned in advance. I think we should be able to manage all this journey actually.
Got it. Thank you. Thank you so much, sir.
Yeah, thank you. Mr. Praneeth? Can you please
Hello.
go ahead with the question, please? Yes, please. Yeah.
Yeah, thank you for the opportunity.
Yes, please. Yeah, you are not audible, Mr. Praneeth.
Users as particular business, but how's the margins?
No, I
difference in both?
missed your question. Initially, you were not audible. Can you repeat the question?
Am I audible now?
Yeah, please go ahead.
So I was asking about the margins for the non-wind segment of the business. I understand it's only a part of the business, but I was curious, what are the margins like and how is it different from the wind part of it? And is there a possibility like creating two separate business units, let's say, to cater to one is non-wind and one is wind? I understand capacity, you're going on a much more conservative basis while expanding. But if the realizations of everything is something marginally better or similar, why is the fact that there's not another business unit just catering to non-wind?
The non-wind, yes, when we build a capacity of 100,000, 200,000 tons, definitely we have a similar kind of thought process where one organization may be dedicatedly running on a non-wind model actually, But you have to understand one thing on the margin front. You fetch a margin when their complexity of the part is very high or the volumes are low. So these kind of scenarios you get. Now, when I specifically speak, whatever the orders we are having in it is slightly better than the wind actually, the margins. But there are some specific cases I get a very good margins. But at the end of the day, it's a very complex casting and the volume is less actually, So it's difficult to say one particular statement, non-wind is always a higher margin and all those things. But blended wise, yes, you can achieve overall a better margins in it because wind industry is driven by the Chinese competition and at the high volumes, highly competitive market actually, So that's another reason we are also looking at taking the sizable, the non-wind segment as well.
But in terms of working capital, how is it? Isn't it better in terms of non-wind particular part of it? Like, how is the working capital difference between both the segments, inventory and receivables side?
See, whether it is a wind or non-wind, today we are following a simple principle, maintaining below 45, 60 days kind of working capital cycle actually. That is our organizational principle, whether it is a wind or non-wind, because we are not allowing the receivables to be get accumulated in the customer's book. And of course, we have a inventory cycle of say 8 weeks kind of the manufacturing cycle, and we also get a credit from our suppliers. So with a net end effect, I see 45 to 60 days kind of working capital cycle. There are cases like where the castings are very complicated and the volumes are low. Generally, we protect the payment cycle. So we take 50% advance and do it. Yes, that is different. But today it is not visible in our book because we are doing a very small business portion of the business. It may be mix and match, but at the end of the day, I don't see any significant deviation in the working capital cycle what we are doing it today.
And so one more question regarding the machining side of it. So in terms of per tonnage, what kind of value addition will be able to keep inside synergy as a result of this? Like in terms of percentage, I understand EBITDA margin we might increase by a percentage, but on a ton basis, how is it going to be? How can we look at it?
Again, it depends on the intricacy of the machining, cycle time, component weight, and the nature of machines used and all. But as a thumb rule, somewhere around if I have to vague number, you have to spell out around 30,000 to 40,000 or even 50,000 rupees per ton is the machining value addition happens.
No, but if that's quite substantial, like I understand we're ramping up the capacity, but will it be a possibility that we might do, let's say, 80-20 split in terms of machining kind of thing? So can that be something that we can see?
No, actually, we cannot run behind one aspect like marginal. We have to understand one thing. in non-wind, getting sizable volume, big casting is very rare. Means wind is the where business, you get a sizable big castings and big volumes actually, no? So we always look at the end value addition. That's a combination of value and volume actually, no? That is how we derive the business. So we do see wherever the opportunities are there, we go and pull such kind of businesses. But today I see that factor is offered by the wind. That's where we are operating actually, no?
Understood.
Yeah.
Just last one question. So when we go to the customer, is it the fact that we give the finished casting, or we just give the rough casting and they take it from the machining partner of yours?
No, we give 100% finished casting. So we are a complete end-to-end solution provider. So straight away, these castings go to the assembly line.
Understood.
Yeah.
That's it from my side. Thank you.
Thank you. May I request Mr. Pushkar Jain to go ahead with your question, please? Mr. Pushkar?
Oh, sorry, my question is answered. Thanks.
Yeah, okay. Thank you. Mr. Rishabh Agarwal?
Hi, sir.
Yeah.
Sir, so the question, so we were looking at some of the notifications by MNRE, and on 31st of July, there was an ALMM notification, which essentially looks to include more indigenous wind turbine manufacturers in the ambit. And now I guess there will be more gearbox manufacturers, nacelle hub manufacturers producing in India. Do you at all see any increased domestic orders because of this notification? That's one, because China is 25% more expensive, so a lot of people ended up preferring that. The second also is, it seems like China again is picking up in terms of their wind demand. So maybe a lot of Chinese capacity will also go towards handling their own demand. So again, in the light of these two, what is your outlook on domestic demand?
You're right. I also heard that in China, they've given a big target for the wind installations, and there is a capacity shortage in spite of a huge capacity actually in China, actually, no. And many foundries, they are denying the export orders because they need to take care of the domestic market. I heard there is a lot of incentive and other things are going on. Now, coming back to your first part of the question, the domestically, I'm also very this thing, ambitious that the domestic market, one is in terms of the installation, second is in terms of the offtake in the casting itself. Actually, that should significantly go out. Government and MNRE is putting a lot of effort to push all these guys. I do know MNRE, when for initially they sent a circular, there is going to be a reaction from the industry. They're given a very short time. I think August was the cutoff date. Actually, you have to do localization, that kind of thing. That's not going to happen because to develop a supply chain, it takes more than a year for them to capacity. So they're going to go back and ask for some extension and all. I think that is they have done or they're in the process. But at the end of the day, government is insisting with a certain value addition from the local suppliers. Actually, maybe 70-80% kind of the local content. So that is definitely is going to add to our demand. Actually, that's where I am very bullish on the domestic demand is going to pick up. One is in terms of installation, second is this policies government which is coming up. Both should help us in increasing our share actually, in India.
So do you expect to be directly included as an ALMM, or do you expect your customers who would be manufacturing gearboxes or nacelles to be included in ALMM, and as part of that, they would be then procuring?
So they have come with one policy. There is a specific quality requirements for the India, which is a BIS certification actually, which Synergy is qualified as a BIS standards, the certification qualified foundry actually, So that generally the outside foundries are not qualified with it. Indirectly it says then majority of the demand has to be acquired from the local, the BIS certified the vendors actually, So that is how the demand is going to be directed towards the local content. And apart from that, there are also guidelines how much percentage of the local content material should be there in the turbines.
Thank you, sir. So just a last question from my side. Is there a seasonality generally in Q1 revenues? Because looking at last 4 years, generally Q1 is lower than Q4.
Yeah, you are right. It's not just about this for this industry. Generally, you pick up any engineering balance sheet, Q4 they do the best numbers. Q1 it goes for a sleep mode. Starts with a very small thing, and then gradually it picks up in Q3 and Q4. Now, if you come back to wind industry, like the first part of Q1 is always low. Q2 is also flat because rainy season wind installation doesn't happen. Then Q3 and Q4 is peak. Means that's the kind of takeoff it happens. Again, synergy revenues were little oscillative because our demand was protected from the export markets. So that is how, if you have seen the Shreyas presentation earlier, I think wind domestic is near zero actually. It means there is nothing has done actually. No, it's mainly because of the domestic players. They do very less installation in the beginning of the year actually. No, but our demand was protected because of the gearbox and non-wind and also export market. That's how we could manage a reasonable amount of this thing, the revenue.
Understood. Thank you, sir.
Thank you. May I request Mr. Amitabh Vatsa to please go ahead with your question, please.
Hi, sir. I'm Amitabh. I work with Sadhan. So my question is basically, since you have 30 years of experience, so my question is slightly more on the industry side, that I've seen you have presented a whole list of all the makers of wind turbines. So I'm curious about two companies. One is Sany and other one is the Goldwind, the market leader. So there are some rumors that Goldwind is setting up shop in India for manufacturing, and Sany already has a shop. So do you have those on your cards? And do you see that the memorandum which came from Government of India, MNRE, is going to shape up the value chain movement with respect to these two players, and generally other any, if you would like to add?
Yes, I can spell out. See, I have also done a lot of exercise in comparing the various regions, cost structure, whether it is China or Europe or India, actually. Of course, US is not into the place. Now, about a month back, Sany has visited our facilities. Of course, naturally, whenever a Chinese player enters, I can get it at 50% cheaper or 35% cheaper. But that is in China, not in India, actually. So there are many experiments have been done. A lot of people coming from outside and putting up a plant in India. Found is such a place. It is not that we are doing something seriously wrong, why our cost structure is higher. That's not the case, actually. No. Ultimately, when you come to a country, there is a certain infrastructure. Like I have to give a typical, the cost of logistics from China to India is say 3%, 4%. For me, it is costing 5% because that is the kind of, because we predominantly do the road transport actually, by sea is 1/4 or even 1/6 of that logistics. I'm giving one of the example. The second is what I understand in China. China is cheaper is not because of they have got some technical advantage. In fact, I have good compliments from many of the Chinese good leaders actually, coming to our foundation and saying, where from you got this kind of technology? That's the kind of compliments what they have given. Means the infrastructure, whatever the technology you have is a far superior than what the Chinese foundries are operating. Now, again, you can question me, then how come Chinese are more competitive than yours? The first thing is the Chinese are competitive is because of commodity prices are cheaper by more than 30%. This is the rule number one. Means then you lost 30% on the commodity itself. Second thing, electricity is cheaper. Like if you typically take an Indian context, the electricity generation is happening from the renewables 3.5 rupees, but I buy back at 10.5 rupees. It's because of, you can say, transmission losses or the freebies, so many things, political costs. See, you are not going to bring electricity from China, right? You have to buy electricity from India only. That's the second part. And also you have to buy commodity in India. That's the second part. The third thing is when you create an infrastructure, you get a lot of incentives by the Chinese government. Like first 5 years you need not pay, or land is smoothly transitioned without much cost, and the subsidized interest rate, then exports for the interest. When you add all 10, 12 things actually, then the game changes. Now, if somebody from China, he goes 1 kilometer away from China, put up his own foundry. He cannot compete with his own foundry in China. Means just I'm giving a theoretical, hypothetical comparison. Now, coming back to India, I believe because we spend a good amount of time, it takes time to learn because it is not an automated thing. There is a lot of skill set involved. You need to build the team, people. You cannot bring the Chinese workers to work in India. The cost will go up dramatically. Means you have to train the people in India. Actually, that's going to take 5 years, 10 years kind of the journey. Actually, it's not an easy task. Any outsider just jumping in and starting, because you are not going to run it on a simply one printing machine or one this thing and go and keep on producing the casting. That's not going to happen that way. So that is another reason why we consider this as a very high entry barrier industry. It's not an easy job to get in actually,
Sir, I have one more question with respect to you talked about you would go to non-wind side, then automotive being one, ZF already there, gearbox and all. But did you consider a railway as a long-term market? And what is your strategy going forward if you want to participate?
Yes, I started my career with railways. I have good expertise in producing railways. We can do it, but it is a little crowded space. That's how I say. Actually, there are already a lot of people and capacities are happening. I see a lot more value-added products beyond railways. That is how I see. Actually, still a lot of components are imported at a very high value. Means we are looking at not just enter at a simple and ordinary foundry what they're doing. We would like to enter in a high technology oriented, high skills, where good value added products. I see that kind of big market in the non-wind segment actually. So we'll see at appropriate time. And I'm not ruling out we should not be entering the railways or anything. It all based on the opportunities actually, because till yesterday, these railways, the manufacturing, whatever is happening for the domestic market, there is a good opportunity. The way globally reset of the whole economics, these things are happening. India may become net exporter of the railways. That's a good possibility because the kind of the trains that Vande Bharat and all they have developed, and there can be an sorry, what is that? Yeah, नीलेश क्या हो गया? स्क्रीन किसका है?
Yeah, I have not shared anything.
Who you given a permission for the shares? Somebody has shared
No,
this.
no.
Anyway, sorry. So what I'm trying to say is, I'm not ruling out. We have expertise and all, but if we have a limited capital, where you want to put, we would like to put a high reliability, good value added area. So today it stands at wind. I do see a lot of other opportunities in that. We'll take it up step by step.
Sir, if one final question, if I may, in terms of competition, you mentioned in past that there are 3 foundries which are dedicated to wind sector. So can you just update us on the status? What is their capacity? Because I've heard that they were also expanding.
Yes, I know SE Forge, they were already invested a lot in the beginning, but they had a challenge in capacity utilization. Probably if you have seen, I think they are using around 20-25% kind of a capacity utilization where they are standing actually. Still they have to go a long way in converting that into the capacity. That is one. And we have a little edge over one of our competitor because they are into SEZ. So if you have to cater to the domestic market, it will attract tax. That's one. And the second thing is always they will have a tag of OEM subsidiary actually. So we are a neutral company. Always we get slightly a bit differentiation in the this thing. This is one. The second thing is the other competitor one who is a MNC OEM. He's also expanding that what I heard. The 30 to 45,000 tons is the number what I heard about it. But I don't see any problem in all of us expanding and still there is a good demand. We are all 3 working in a different models. Like Synergy is the only company where more or less catering to all the OEMs. I'm talking uniqueness of the Synergy. I'm more or less a neutral company. And we are the only company into gearbox. We are also significantly in the non-wind. So we have a much broader market than, of course, we are sacrificing our efficiencies in the journey because we are highly diversified actually. Because of that, when I compare, like as I mentioned, the focused industry get a better productivity, better this thing, but it comes with a lot of risk. If one of the customer demand goes down, your revenues are highly volatile. So we try to protect that volatility with a diversification.
Thanks a lot.
You're most welcome. Mr. Nitin Dharmawat, sir, please go ahead with your question.
Yeah, thank you, Reddy sir. Thank you for the opportunity. Today, Reddy sir is on fire to protect the opportunities and citing the opportunity. Thank you very much for all the elaborate answers. My question is about the hypothetical case that you talked about, that we may have 50% revenue from wind and non-wind. So in such a scenario, what could be the blended EBITDA level that we could anticipate wherever it happens, and the kind of opportunities that we get? So just based on some assumptions that you might be having in your mind.
See, I have seen the many numbers. I'm not just talking about the wind industry or the foundry, general engineering, like whether you pick up a forging and all. Somewhere around 20-25% is the EBITDA margins what all other guys are doing actually. At a matured level, if we do something like more or less everything good infrastructure like machining, then solar plus foundry, if we do it, definitely it should be about 20% kind of the number actually. So I don't see any problem in this achieving this figures. I'm talking blended actually. Again, see, there can be good opportunity. I see a lot of RFQs wherein the high valuated. Only thing I'm little scared. It may take a lot of energy actually. We need to put up a lot of team. We have to see those numbers, but the margins are very high. I can say 30-40% kind of the big orders are there, but it will not impact my balance sheet because unless I do a big sizable volume of that kind of the margin business into my this thing weighted average. So if you are able to build, The challenge with those kind of businesses, volumes are low and the complexity is very high. So because of that, then building a big balance sheet of 1,000 crores or 2,000 crores becomes a challenge. So at the end of the day, we work on the model. A significant portion comes from the volume-based business. Second is a value-based business. So a blend of both together should be able to push beyond 18-20% kind of the margins.
And my second question is about India has signed one agreement with UK, and since we do not have any significant presence right now in Europe and UK geographies, so is there any possibilities of exploring the opportunities in that market? I'm not aware about how is the maturity of the wind market in that area, especially. So if you can elaborate something on that.
I don't see UK is a big market for the wind. Today also we have some small business which in Europe it is going, that is going to UK only. Volvo is basically that one customer which, but it's a very small volume actually, really we are not explored what kind of opportunity over there. We are in just discussion. But today what I see is my table is full today. Means we are trying to see what is there in the front and we're trying to take it up actually, Yes, definitely we can look at not just I'm talking about the UK, even other countries also. At the end of the day, whether it is a free trade, taxes and all, there are certain segment of casting. Value has got no meaning. Means they are ready to pay any price. It's a very complicated and needs a skill set. And the price is not the matter. It is like what you call pharmaceutical actually. The patient doesn't look at the price of the medicines, what price he should buy. What is important is what is the value of that medicine. The similar way, there is such a segment in the casting component. Always it comes to my one mind actually. If you typically look at 110 million tons is the total global casting production, out of which India does about 11-12%, 11 or 12 millions actually. If you look at the value creation by country like India, it's not a big number, means 150, 170 rupees per kg. But the same thing, someone like US, they're doing at a 400 rupees weighted average price actually, means in terms of the value terms, US may be doing 3 folds or 4 folds than the India what we are doing for the same capacity production happening in the found industry in India versus USA actually. Means there are a lot of opportunities. We need to explore the high value added items, the lying over there. We need to search and dig into our business actually.
Got it, sir. My final question is about the capex. So when are we, announcing the next cycle of capex? What is the plan on that side?
If everything goes right, we are looking somewhere around Q2, Q3. Means we are typically looking at 2 quarters of good performance. That's what we are first focusing on. First complete the capex and get into 2 quarters like what we have projected. Then we are good to go.
Sorry, I missed your point.
The point what I'm trying to say is we are looking at somewhere around Q2 or Q3 of FY27. Means the logic is the first we would like to complete the capex and want to see the numbers what we have projected for 2 quarters. Then we are good to go.
I got it. Thank you
Yeah.
so much and wishing you
You're
best.
welcome. Mr. Vaishnavi Sabu.
Yes. Hello, sir. Thanks for the opportunity. So I just had one question. If I remember, it is related to the capacity expansion. In the last con call for the foundry expansion, that was supposed to be ready by Q2 FY26, but there is a delay of 1 quarter, I believe. So what is the reason for that?
Yeah, you are right. There is almost a 2 months delays there in the foundry project. One is this what you call the civil work what we are doing it. The field what we had, it is a completely rocky foundation. It is taking a lot of time for putting up the foundation. That is one. The second part is Q1 always the labor shortage issues actually. Typically a lot of migrant labor keep moving across the country due to marriage and other things. Around 20-30% labor shortage in the field, not just in this industry. Generally, this is the trend what I was saying. Because of that, there is the delay in the project by almost 2 months. But I don't see any impact because of this 2 months delay, because the capacity what we have aligned the order book schedules and all is with the Q3 and Q4 actually. I don't see any impact on the outcome side. Yes, there is a delay on the completion of the project side.
Okay. Thank you. That's all from my side.
May I request Mr. Pratik Jain again? I see your hand. Yeah.
Hey, hi, sir. Thank you. Thank you for the opportunity again. So just two bookkeeping questions. So out of our 150 crores of debt, how much of the debt is sorry. Firstly, what's the cost of debt we pay?
Today, around 8.75%, I think. That is the interest rate what we are paying to the banks.
Got it. And secondly, on the datas, we do bill discounting on it. So can you please clarify how much of our bill discounting is basically recourse and how much is non-recourse?
Almost all the bills are without recourse. No
Okay,
recourse.
without. Got it.
There are two parts. Domestic, we directly discount with the customers. We don't go to any third party, so that we don't have any hassles with somebody third party coming and claiming. As far as exports is concerned, there is a government scheme as available wherein directly we can discount the receivables without any recourse model.
Got it. Got it. And so just last question, we had proposed around 187 crores of capex in the last FY25 and FY26. We had already done 83 crores. So is it that this year we'll be doing around 104 crores of capex?
No, it's
Balance.
ongoing. It's only payments have not happened as in Q1. For example, now from China already, the machines which we have manufactured is ready for dispatch. Then overnight 130 crores invoice will come actually, no? So we have already ordered all those 187, barring maybe 10, 15 crores, some tooling and other things. Majority 80-90% is already ordered actually, no? It is only accounting, I think, is pending. That's all.
Got it. Got it. Thank you. Thank you, sir.
I see Mr. Jignesh Vaidya.
Yeah.
Please go ahead.
Thanks for the opportunity, sir. So wanted to understand, since your capex will go live by around October or November, so from Q4 onwards, our utilization will be how much for the new capacity? 40-50% can we assume going forward, or FY27 only we need to assume?
See, we are trying to target the full capacity utilization in the Q4 actually, no? Full means 85-90% kind of the capacity. We have to see how this progress. It also depends on the customers and development, and so many things are happening. But we see a good sizable capacity utilization in the Q4.
Okay. So broadly, maybe in Q3 and Q4, since our utilization would not be full, so maybe initial expenses of the new plant and employees will be higher. So there can be a small hit on the margins for a couple of quarters. Is this fair to understand?
You are right. Even this quarter also, see, we already started doing a lot of recruitment on our machine shop and other things. Actually, marginally there is increase in a quarter-on-quarter basis. There is increase in the manpower cost actually, but that will also get offset because the solar is getting commissioned. Some revenue will also happen. So I see not much impact onto the margins. So it will go side by side actually, The project is staggered in such a manner. It's not going to wait till all the activities get completed. Like as I mentioned, the solar, if it get commissioned in the next 1 week or so, that will start contributing something to the bottom line. Second, next month we're expecting a first phase of machining get completed actually, That will also contribute something, excepting maybe maximum 0.5%, 1% here and then for a short period of time, maybe a quarter. But I don't see big impact on the margins because of all this, this thing, manpower cost and other things actually.
Okay. So any major benefit that will have on by any government PLI schemes that they run for our new capacity? So that can also be added?
Because the new facility what we have put, there is an incentive from the Maharashtra state government. I think, we get the refund of the capex, but that is spread across over a period of 10 years. I think 35 or 40 crores incentive amount is already sanctioned for us. Maybe come out around 3-4 crores per year during next 10 years based on the GST collection from the Maharashtra state. So that incentive is there with us.
Right. Okay. Thank you.
You're welcome. Nitinji, still your hand I see. Do you have any more questions, please?
No, sorry, sir.
No.
I forgot to lower it.
Yeah. Thank you all once again. Nilesh, can you please conclude? I don't see any further questions. Yeah. Nilesh, you are mute.
I was saying that a couple of questions has been received from Mr. Praneeth, but due to time constraint, I have sent my email ID to him. So we can email him. Or shall I take right now?
They are present here.
Mr. Praneeth?
I think.
Yes, I'm present.
Yeah, he has already asked the question, I think, Mr. Praneeth.
No. I have like 2 more questions regarding how the supply chain is developing beyond China in terms of wind castings. So if you could give some light based on that.
See, the supply chain means there are four regions which I always speak: US, Europe, India, and China. Manufacturing point of view, actually, no. So today it is highly concentrated towards the China. There are a lot of discussion on Turkey and even Vietnam or even other Mexico. So there are a lot of discussions. But at the end of the day, even Brazil also. But I see the India is the best competitor next to the China. Actually, that's the kind of scene. I have seen numbers of the Brazil production also. I heard 50-60% more expensive there. Even I know the numbers from Mexico as well. It is closer to US economy. It's in the dollar economy, actually, you know. So that way, if you see, the India should catch up very quick next to the China. That's my thing, you know.
I understand that, but in terms of capacity, what percentage do they have, like in terms of sheer capacity and capacity utilization at this point of time?
Capacity of what? You are talking about the global demand?
Is capacity of their existing supply. So I understand it's basically concentrated in China right at the moment, and next we come India.
See,
So I was wondering
it's
about this.
a little, this thing, what you call, a lot of Chinese capacity. What I heard is for the smaller megawatt turbine and those kind of things are there. There is also a good amount of capacity for the big turbine because nowadays a turbine class is moving away from say 1 megawatt, 2 megawatt to 5, 6, or even 8 megawatt kind of the numbers. So many of the foundries cannot do such kind of big capacity, the turbines, actually, you know, that is one. So it's not about meagerly looking at the capacity. You should also look at the relevant capacity. That's one. Second thing is, like it's already coming from China. So there is nothing to additionally whether capacity gets added or it gets diminished. It will only the now buyer strategy is to pull out something out of China. That is how I see, actually. You know, of course, cost is the criteria, but that is not the only criteria because they are trying to de-risk and try to develop alternate supply chain, actually. No.
Understood, got it. And in terms of part of capacity expansion, can we do equity infusion? Because as at this point of time, you're mentioning that you do not want to stay in the balance sheet. So I was wondering, can equity infusion be a better, faster way to accelerate without stressing the balance sheet?
Yes, we will do it at appropriate time. That is also in our cards. Next time when we do, means first we would like to finish our commitment, what we are committed. Say from 30 to 45,000 capacity utilization of same 85-90% kind of thing. Plus we also given a guidance on the certain margins. Then I see good value in the organization. There should not be any challenge in funding the upcoming capexes in the combination of both because our balance sheet also becomes bigger, internal accruals also accelerate, plus some equity infusion and borrowing. That's why I mentioned one single number. We don't want to exceed our debt equity ratio more than 1.5, preferably closer to 1. So if we keep this goal, whatever the capex is, we'll manage how much has to be invested, how much we are able to manage through internal accrual. That's how we'll be proceeding.
Understood. Thank you.
You're most welcome. Yes, Nilesh.
So thank you everyone for joining today's earning call and making such an interactive call. So on behalf of entire Synergy, I would like to say thank you to every investors and analyst category. Thank you. Thank you.
Thank you all. Thank you.
Thank you, everyone.
If you found this video helpful, please like, share and subscribe to Concall India for latest upcoming Concall.